JCPenney gave Ron Johnson about 17 months to reinvent a century-old retailer. The plan sounded disciplined: strip perpetual discounts, anchor on everyday pricing, modernize the store. But the reset collided with something leadership underestimated: customer behavior. Reports cite a revenue decline of nearly 25% in 2012. The reset moved faster than adoption could follow. This wasn't just a bad season, it was a control failure in how change gets tested, sequenced, and governed inside a live retail system. Strip familiar promotions without an adoption buffer, and demand can crack before store teams or capital plans catch up. By the time governance reacts, trust may already be damaged across pricing, traffic, and execution. 17 months is enough time to launch a reset. It is also enough time for strategy without adoption safeguards to become self-inflicted damage. But at the start, the plan looked sound. So what, exactly, did JCPenney think it was fixing? The turnaround promise begins with a logical diagnosis. JCPenney appears trapped in promotion dependence. Constant coupons train customers to wait. Margins become harder to defend, and the brand message blurs into noise. Ron Johnson's reset targets that cycle directly, replacing perpetual sales signals with an everyday value posture meant to simplify decisions and restore clarity. On paper, it is disciplined strategy, not recklessness. The empathy is real. Leadership is not solving a fictional problem. It is trying to break a behavior loop that can exhaust both operators and customers. And in corporate America, leadership resets are common. PwC's broader context shows roughly 10 to 13% of S&P 500 companies appoint new CEOs annually. The same transition research also cautions against easy narratives. There is no clear universal performance edge for insiders or outsiders in turnarounds. A new chief executive can change direction, but that change alone is not reliable proof of recovery. This is where the first blind spot appears. Strategic elegance is treated as evidence, while customer behavior evidence lags behind execution speed. The removal of constant sales and coupon cadence asks shoppers to relearn value on management's timeline, not their own. That is a high-friction demand experiment inside a live retail system. One provided summary cites a 25% revenue drop in 2012, though the research packet flags that figure as not independently verified within the retrieved set. Verified or not, the governance warning is clear. When conviction outruns validation, a turnaround can become an exposure event. So when does persuasive strategy cross the line into operational overconfidence? A double-digit decline. That figure circulates as the defining score of the reset. Yet, in this record, it remains a cited claim without full corroboration in the retrieved sources. That gap is the point of this chapter. Narrative momentum rises faster than verified operating proof, and decisive leadership is framed as progress before customer acceptance is demonstrated at scale. In many turnarounds, confidence itself becomes a market signal. Bold action is interpreted as competence, even when demand elasticity is still untested. Inside the system, the risk is more technical than theatrical. Governance appears to run behind strategy speed. Staging appears constrained. Stop-loss thresholds are not clearly visible in the provided materials, and rollback triggers are not documented with sufficient precision in this packet. The organization commits broadly before behavior is validated broadly. When that happens, management is no longer measuring a contained pilot. It is exposing the full enterprise to a live assumption about how people buy. The research file is explicit about its own limits: insufficient source-backed detail for precise valuation, market cap, and stock reaction figures during the tenure. Core quantitative claims not fully corroborated beyond the general tenure and failure narrative. and repeated caution against overstating what the evidence can prove. Even so, the case is repeatedly used as a warning in discount strategy discourse. Remove familiar promotional signals without verified migration, and trust can fracture before financial reporting catches up. This is the hubris phase, when story quality outruns evidence quality. Then the market delivers a verdict. But what breaks first? Traffic, conversion, or trust? The break comes not at the cash register, but in the customer's mind. Promotional architecture changes faster than customer psychology. Shoppers are asked to abandon familiar deal signals all at once, but no equally trusted replacement is in place when they arrive. In retail, value is not just price, it is the ritual of proof. Remove the ritual and urgency fades. Urgency fades and repeat behavior starts to thin. That is the mechanism here. Not one theatrical miss, but a compounding loss of purchase triggers across ordinary decisions. One summary in this packet cites a steep revenue decline in 2012 tied to the removal of discounts and coupons. The same packet also states that no specific figure is independently corroborated within the retrieved source set. That distinction matters. It matters for accuracy and it matters for fairness. The file supports a pattern of strategic failure and leadership fallout. It does not prove a clean, single-line causality chain from one pricing decision to one outcome, as if a collapse this large ever moves on only one rail. What is verified is the governance outcome. After about 17 months, Ron Johnson is removed. In a Form 8K, the company discloses that he steps down and Mike Ullman returns as Chief Executive Officer effective immediately. By that point, the operating problem is no longer theoretical. Once demand softens inside a fixed-cost retail model, downside pressure accelerates, flexibility contracts, and every path back costs more, like trying to turn a ship after the water is already coming in. So the inflection is clear. The strategy does not merely underperform, it disrupts the customer's decision framework before trust is rebuilt. Leadership changes, but the brutal question is already loose in the system. Can a CEO swap reverse demand physics once they are in motion? The crisis does not end with a CEO exit. It migrates into assets, legal structures, and time. After the failed reset and leadership reversal pressure, JCPenney eventually files for Chapter 11 in 2020, and the damage is no longer measured only in sales narratives. It is measured in how a national footprint is unwound, parcel by parcel, claim by claim. A post-bankruptcy liquidation vehicle is formed to dispose of former properties, including retail locations and warehouse assets. That mechanism matters because it turns strategic failure into a long-duration financial process. Stores that once represented growth optionality become liquidation inputs. Real estate that supported operating scale is recoded as recovery collateral. The operating company moves forward in reduced form, sited at around hundreds of stores under new ownership structure, while a separate system continues to process what the old system left behind. Trust-level reporting later shows modest net cash generated from operations and a scheduled cash distribution to certificate holders. The amounts are real, but the signal is harsher than the dollars. Years after the original strategic break, residual value is still being extracted through controlled disposal, not organic expansion. Creditors wait. Investors reprice expectations. Local labor markets absorb slow adjustment instead of clean resolution. This is the forensic endpoint of a control failure. Not one bad quarter, but a multi-year conversion of retail presence into runoff economics. If this is the cost curve, what governance design could have interrupted it before the system crossed from strategy risk into asset liquidation? The post-mortem is brutally clear. The premise was simple: simplify pricing to rebuild trust. But the escalation came fast. The model went system-wide before customer relearning was proven. The hidden fragility was deeper. Shoppers were not just buying price points. They were buying promotional cues that signaled timing, value, and confidence. In retail, those cues are not decoration. They are part of the product. Then came the trigger. Demand response missed management assumptions, and the fallout spread well past the strategy itself. After about 17 months, leadership broke, but the consequences kept running. Governance is the real subject. Leadership replacement is common, roughly 10 to 13% in large public company cycles. But succession is not a performance cure. That matters here. The JCPenney case shows that a strategy can sound coherent in the boardroom, but still be vetoed by the market. And the widely cited 25% revenue drop claim for 2012 remains, in this source packet, a repeated figure that is not fully corroborated across the broader retrieved set. That caveat is not housekeeping. It is a control principle. Verify the outcome before you build the story of why it happened. So the framework for founders and investors is practical. Pilot before rollout. Set behavioral proof thresholds before narrative commitment. Define rollback triggers before launch, not once stress appears. Require board-level challenge protocols that test customer evidence against strategy decks in real time. If the numbers are the cockpit, governance is the instrument panel that tells you whether the plane is actually climbing or just pointed upward. And when attribution is uncertain, use litigation-aware language discipline. Turnarounds rarely die from lack of ambition. They die when narrative certainty outruns operational evidence. When the story gets ahead of the shopper wins. In your own organization, which decision fails first if customer behavior casts the only vote that matters?